determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But we want to know what is the worth? What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting its determination of a present value from a future value.
Yes, so what you are told is applying the requirement of IS-33 earnings per share, not less than divided ended 31st of July 2023. 31st of July 2023. Now, this question basically is a repetition of another question. And the other question was requiring actually the computation of earnings per share for 2 years, 2022, 2023. Let's do the same here. So we compute the earnings per share for the 2 years, but if you check on the question, the examiner was just requiring candidate to compute the earnings per share for the basic earnings per share for 2023. But let's start by computing the basic earnings per share for 2022, then for 2023. So we start with this year here, that is the basic earnings per share for the year which ended 31st of July 2022. Now, what do we need here? The first thing we must remember is the formula of computing the basic earnings per share, which is basically the PATOS, divided that with what? With one-offs. Divided that with what? With one-offs. And basically, I want us to start by computing this PATOS. I want us to start by computing the PATOS. And basically, for us to be able to save time, let's compute the PATOS for these 2 years, 2022 and also 2023, because the computation is just the same. The approach of computing this PATOS is the same. Now, you have to remember, how do we compute this? How do we compute the PATOS? I've said we always start with a profit after tax, which can also be known as net income or the profit for the year. To this, we less a number of items, the preference dividends for the current year only. We also less the profit, which is attributable to non-controlling interest, and also we we add any loss from discontinued operations. So if you check on that information which you have there, there is nowhere we are given information about what? Discontinued operation. There is nowhere we are told there was a loss from discontinued operation. So let's start with this one, profit after tax. Profit after tax, where do we have that? We have that below paragraph 1, where we are given the statement of profit or loss. Can we go to where we have the profit after tax? Profit after tax should be below the profit before tax, less tax, and then below that we have the profit for the period. The profit after tax for the period. We start with that of 2022, and it's also important for us to note here that our figures are in million of shillings. So this one is for 2022, that's what you're going to start with. For 2022 is 480 million. For 2023 is 650 million. 650 million. Sasa? Yes. So then to that we less the preference dividend. Where do we get the information about the preference dividend? We get this from the information we have below paragraph 2. Paragraph 2, where we given the statement of financial position extract. So because in our case there, you can see our company had issued equity shares or ordinary shares, and still our company had issued 4% preference shares. And I hope you can see the examiner has specified that these are non-redeemable. So because if we were told they were redeemable, then you have said you don't less their dividend here. So the preference dividend, basically for the 2 years, will remain the same because you can see there was no any change in the preference share capital, and the preference dividend should be 4% of the preference share capital. I hope you can see the preference shares issued at 4%. The dividend to be paid each year should be equal to 4% of the preference share capital. Preference share capital is 200. And basically this will give us what? Will that give us 8 million? 8 million, will that give us 8 million? 4%? Yes, so that one is 8 million. And basically that remains the same for 2 years. And then to this, we also less the profit attributable to NCI. Do we have the profit attributable to NCI? Yes, because these are information about a group of companies. So that profit attributable to the NCI is given below paragraph 1. We should be able to go to something, or there is something we're given in that statement of profit or loss. We are given the profit for the period attributable to. Can you see that? Profit for the period attributable to the owners of the parent and attributable to the non-controlling interest. That's what we are interested with. The profit for the period attributable to the NCI, to the non-controlling interest. And not whatever you're given down there, because down there you can see we're given the total comprehensive incomes. So what we left here is the profit attributable to NCI. Profit for the year attributable to NCI. For 2022, that one is 60. And for 2023 is 90. Is what? Is 90. So take into account, we don't have any loss from discontinued operation. We should be able now to get our patos. We should be able to get our patos. So what will be the patos for the year 2022? It will basically be 480 minus 68. And that will give us 412. We do the same. We take 650 minus 98. And basically this will give us what? That will give us 552. So in our case, we already have what? We already have the patos basically for 2 what? For 2 years. So then I want us to move and we compute, first of all, we compute them as the one knows for 2022. And then from there, we compute the one knows for 2023. And then we compute the diluted earnings per share for 2023. But first of all, we deal with the 2022. So we compute the weighted average number of ordinary shares. Now, first of all, can we go to the last paragraph? To the last paragraph of this question. In the last paragraph, where we are given various transactions for the issue of shares, note 1, 2, 3. The first paragraph here, to during the year which ended 31st of July 2023, the following changes took place. So those changes which are given in paragraph 3 are for the second year. For the second year, they are not for the first year. So mean that during the first year, 2022, there was no issue of shares. So therefore, how do we compute the one-offs? So we're going to compute the one-offs using the information we have below paragraph 1. Can you go to, not paragraph 1, paragraph 2? Below paragraph 2, where we have the statement of financial position. Can we go to the statement of financial position for 2022? So we are given the statement of financial position for the year which ended 31st of July 2022. We are saying we have 2 years. 31st of July 2022 and 31st of July 2023. This is the first year, the second year. So we are computing the basic earnings per share for this year. We have managed to compute the one-offs, the patos. We want to compute the one-offs. I hope you can be able to recall what we said as far as the computation of this is concerned. We take the shares which were issued at the start, and then we add the other shares which were issued during that year. But basically what you have said is that the information we have in below paragraph 3, those are the shares which were issued during this year. So during this year, there was no issue. There was no good issue. If there are no shares which were issued during a certain year, the shares issued at the end of the year and the shares issued at the start are the same. And basically that is always your one-off. That is always your what? Your one-off. So if you're given, because you'll also come across other questions whereby you're just given shares issued at the end of the year, you are told during that year, there are no other shares which were issued. It means that these shares issued at the end of the year are the same shares which were issued at the start, and therefore that would be your one-off. Because the shares issued at the start, you have them. Were there some shares which were issued during that year? No. So therefore, in case you come across that question, then it is important for you to remember that. So therefore, can we go to the information we have below paragraph 2 and we determine how many shares had been issued at the end of 2022? So we will take the ordinary share capital of this company or the equity share capital of the company, which is basically given as 400 million. We divide that with the par value per share because this is the value of the shares issued. Can you be able to see the par value per share? The par value per share is 0.5. 0.5, that one is within our statement of financial position. We are told the company had issued, or the ordinary share capital of the company is 920 and 400, and inside the bracket you're told the par value per share is 0.5. Are we together? Yes. So meaning that here the shares which were issued at the end of the year were 800 million. 800 million. And take into account during this year there were no other shares which were issued. It also means that the shares which had been issued at the start here were 800 million. So therefore, in terms of how we compute this, we say that the shares which had been issued at the start automatically this year, the next year here will start 1st August. So this year started 1st of August 2021. The shares which had been issued, we refer to that as the balance brought down, were 800 million. 800 million. Our figures here are in million of shillings. These are not shillings because these are specifically the number of shares. Specifically the number of shares. And then during that year, there were no shares which were issued. In fact, we can just confirm that from the information we have below paragraph 3. So the first transaction, number 1, there were 200,000 shares which were issued. If we go to the last sentence, the issue took place 1st November 2022. 1st November 2022 is within the second year because the second year started 1st August 2022. 1st November 2022 is within the second year. Number 2, that one is, I think, is a right issue, but we will be able to see it was made on 1st Feb of 2023. 1st Feb 2023 is within the second year. Number 3, 31st July 2023, the company make a bonus issue. You can see that is still a transaction for the second year. So during this year, 2022, there were no shares which were issued. So it basically means that the weighted average number of ordinary shares there were no for this year is what? Is 800,000. Is 800,000. Is 800,000. 800,000. And I think in our case, we are basically done. We are basically through. We are basically through. So what we need to do, yes, a question, who is asking a question here? So 200 in conjunction with the acquisition of another business. No, and we are saying when did the first year ended? Because that's what you need to understand. And mwaka ya kwanza iliisha lini hapo? An iliisha 31st July. Kwa hivyo 1st November 2022 hiyo ni mwaka ya pili. Is that clear? Hiyo ni mwaka ya pili. And 1st November 2022 should be the second year. The first year ended 31st of July. So 1st November ni mwaka ya pili. Sawa? Yes, yes. So in our case, I think now we can move and compute the what? The basic earnings per share by basically applying our formula per TOS, this one, 412. And remember all our figures are in million of shillings, all of our one-offs, which is basically 800. And this will give us what? This will give us what? Let's try to add it so that we finish on time. We have 412 divided by 800. And basically this will give us 0.515 per what? Per share. 0.515 per what? Per share. Is that what you're getting? Is that what you're getting? Is that what you're getting? Yes. Now next, let's compute the basic earnings per share for 2023. For the year which ended 31st of July 2023. So remember, you have already computed the PATOS here. So what we need to compute is just the one-offs, the weighted average number of ordinary shares. So in this year, we have a number of transactions which took place. So what we do, we start with the shares which were issued and fully paid at the start of the second year. So the second year, we know the first year ended 31st of July 2022. The second year, you see, started the following day, 1st August 2022. So 1st August of 2022. So the first thing we need to do here is to determine how many ordinary shares or equity shares had been issued and fully paid, were issued and fully paid at the start of the second year. And remember, our figures are in million of shillings. Now, that is something which the examiner will not have given you, especially whereby you have 2 years, which are you have 2 years which are following each other. So because automatically the shares now which were issued and fully paid at the end of 2022 will be the opening shares in 2023. You see, at the end of 2022, the company had issued 800 million shares. So those will be the shares issued and fully paid at the start of the following year. Are we together? Yes. So the shares issued and fully paid at the start of the second year are 800 million. So then to this, what do we need to do? We need to add the other shares which were issued within the second year. We have those shares in note number 1, 2, 3. So let's go to note 2. Let's go to note 2. In note 2, we have 200 million equity shares were issued in conjunction with acquisition of another business. These are shares issued in payment of a purchase consideration. These equity shares were issued at full market price at the date of the issue, which is 1st November 2022. 1st November. And I hope you can see how I'm recording all these transactions. I'm starting with the date, a short description, and then the amount. Or the number of shares, not the amount, the number of shares. So here we have shares. We can just refer to this as issue of shares at full market price. So the shares which were issued here were 200 million. And then you have now to remember what you have said in relation to the shares issued to pay a purchase consideration or the shares which are issued at full market price, because these are shares issued to pay purchase consideration. We have said such shares should be weighted on time basis. Multiply them with the proportion of time they were held. You can see those shares were held from November all the way to the end of the year. And tunajua mwaka inaisha 31st of July. So Fred, you're saying 2 months. No, those shares were held from November to 31st of July. Those are how many months? They are actually 12 months. We exclude which month? We exclude August, September, and I think October. Yes, I think we exclude 3 months. Yes, so this should be 9 months. We have November, December of 2022, and then in 2023 we have January all the way to July. So those are 7 months. 7 months in 2023 and 2 months in 2022. Those are a total of 9 months. So we multiply this with 9 all over 12. 9 all over 12. So this will give us what? That is basically like 3 quarters. And basically that will give us what? 150. Is it coming to 150? Is it 150? Is it 150? Yes. Yes. So that's basically how we treat those shares. Let's go to note 2. Note 2, we are told 300 million ordinary shares were issued for cash to the existing shareholders. Anytime you see an issue to existing shareholders and it is for cash, this is a right issue, because shares can be issued to the existing shareholders in 2 forms. It can either be a bonus issue it can either be a right issue. But because the shares here automatically are issued for cash, these are not a bonus issue. So were issued for cash to the existing shareholders on 1st Feb 2023. 1st Feb 2023. 1st Feb, the issue price was 1.5 per share, which was represented 25% of the traded market price before the time, which was 2 shillings. Now, this is the issue of of additional shares to the existing shareholders of the company at a discounted price to the market price. So the examiner here was not specific, but it's obvious, it's upon you to know that these are right issue. These are right what? Issue, because you can see it meets all the features of a right issue. The shares are issued to the existing shareholders, and number 2, they are issued at a price below the market price. So these are right issues. These are right issue. These are right issue. Now we have said that in addition to the right issue, or once we have shares which are issued during the right issue, we need to split these shares into 2 components. Issue at full market price, and number 2, we compute the bonus what? We compute the bonus element. We compute the bonus what? Element. But basically, before we do that, there is something we need to compute here. And basically, that is something we have referred to as the theoretical X-rate price. The theoretical X-rate price, we have said, is the expected market price per share, expected market price per share after the right issue. So there is a very, very simple approach of computing this. Very, very simple approach. First of all, we determine how many shares had been issued by the company before the right issue. Before the right issue, how many shares had been issued by the company? You can't get that in the question. You can only get that from our question here. How many shares had been issued before the right issue? The shares which were issued, which had been issued by the company before this right issue, were 800 plus the shares which were issued here. Hapa ni shares ngapi zilikuwa issued? Who can tell us? How many shares were issued here? I'm told by Fred they were 150. Hapa ni shares ngapi zilikuwa issued? And Edith, Patrice, yes. Shares zenye zilikuwa issued hapa sio 150. Hapa unachukua the actual shares which were issued. The actual shares which were issued ni ngapi? Ni 200. That is another trick. If you take 150, you get it wrong. So the shares which were issued before, because these shares, remember, they have already been multiplied with the proportion of time. The actual shares issued were 200. So you take this plus this. So the shares which were issued before the right issue, zilikuwa 1,000. 1,000. And what was their market price per share? The market price per share, this one, we have it in note number 2. So the market price per share before the right issue was 2 bob, was 2 shillings. Are we together? Yes. And then how many shares were issued by the company during the right issue? During the right issue. During the right issue, as per note number 2, the company issued 300 million shares at a price of 1.5. At a price of 1.5. Sasa ukikuwa na hizo values, ukikuwa na hizi figures, to compute the theoretical X-rate price becomes quite simple. And this is the same approach you're using in FM, is only that I want us to avoid the formula. I want us to avoid cramming the formula. So what you do here, take the shares which were held before the right issue. This one, 1,000. 1,000. You multiply them with their market price, which was 2. I hope you can remember something related to this. You did something related to this in FM. And then you take the shares which were issued during the right issue. This one, 300 million times the issue price. Times the issue what? Price. Are we together? And then divide that with the total shares which were issued before and after. The shares issued before the right issue, 1,000, plus the shares issued during the right issue, 300. That is simply how you compute what? The theoretical X-rate price. The theoretical X-rate what? A price. So let's finalize on this. So we have this one is 2,000, and this is 450. 2450 divided that with 13. I hope that is what you're getting. Yes, I'm getting something close to that. 1.885. 1.885. That is now called the theoretical exercise price. Always in these questions for theoretical exercise price, there is a mark for that. There is a mark for this. So having that, we come back here. We split these shares. Remember the formula. We have said to compute the shares issued at full market price. Compute how much amount was received by the company from the right issue. The amount received from the right issue will be equal to the shares issued during the right issue, 300 million times the issue price, which is 1.5, and then we divide that with the theoretical exercise price, which we have computed there, 1.885, and then these shares must be weighted on time basis. They must be multiplied with the proportion of time they were held. These shares, remember, they were issued from Feb. They were held in Feb, March, April, May, June, July. They were held for 6 months out of 12. 6 months out of 12. So let's work out that 300 times 1.5 divided by 1.885 divided by 2. What are you getting here to the nearest whole number? The nearest whole number, what are you getting here? 119, eh? 119. Is that what you're getting? Yes, 119. So then we compute the bonus element. Remember the formula. Recall the formula. We have said we take the total shares which were issued during the right issue, which are 300, minus the issue at full market price. The issue at full market price is not what we have here, but basically this is how we compute the issue at full market price. 300 million times 1.5 divided by 1.885. I usually advise the student, can you repeat what you have here? Majority of the students take this, which is basically wrong. You should take this before multiplying that with the proportion of time. And then you also have to remember that these shares should not be weighted on time basis. The bonus element should not be weighted on time basis. 300 times 1.5 divided by 1.885. We left that from 300. And that will give us 61 million. 61 million. Are you getting that? 61 million. 61 million. Yes. So basically that's how we deal with the right issue. And I've said these are concepts you'll come across in all questions for earnings per share. In all questions for earnings per share, you'll come across that concept. So it's better you understand how we deal with that, especially how we compute the theoretical exercise price and how we do that split. Finally, note 3, we're told that on 31st July 2023, the company made a bonus issue. 31st July, not 31st July 2023. Is that the end of the year? Is that the end of the year? Yes, actually, that is the end of the year. So our company made a bonus issue. Now, those shares automatically, you have to remember that, or in this case, it's important to note that these shares will have to be considered here because they were issued during the current year. And basically, what you have seen is that such shares, are they supposed to be weighted on time basis? No. These ones will not be weighted on time basis. The shares which were issued here were 540. So we are told the bonus issue of 540 million were completed capitalizing to 70 million. So in other terms, you see, anytime the company make a bonus issue, those shares will have to be paid by the company from the existing reserves. What is the total value of these shares? The total value of these shares is 540, and I hope you can be able to remember the par value per share. Can you be able to remember the par value per share? The par value per share, which we have in our statement of financial position, can you remember that par value of 0.5? Yes. You multiply that with 0.5. So the value of these shares is 270 million. So this 270 will be paid by the company from the reserves. And actually, we are told the company paid for these shares using the retained earnings. So what we use here is not the value of the shares, we use the number of shares. The number of shares. And basically, this one, we don't have to weight them on time basis. And I think in our case, we are done. So what we need to compute now is the weighted average number of ordinary shares. We basically add all that, whatever you have here, from 800 all down to 540. So you have 800 plus 150 plus 119 plus 61 plus 540. And basically that will give us what? That will give us 1670. 1670. 1670. I hope that is what you're getting. So having done, we then finalize by computing the basic earnings per share. We take the PATOS, which I've already computed here, 552 million divided by 1/0, which we have here, 1670. This will give us what? 552 divided by 1670. It will give us 0.331 shillings per what? Per share. Shillings per what? Per share. Shillings per share. Okay. Yes, I hope you're getting that. I hope you're getting that. Are you getting the same value? Are you getting the same value? Are you getting the same value? Yes. Now we do the last part. The last part, what are we required to do? We required to compute the comparative figure for 2022 to be reported in the year 2023, given that the EPS, the earnings per share figure originally reported. Okay, that is not important. Basically, what you're required to compute in Roman 2, what you're required to compute in Roman 2, we are required to compute the restated earnings per share over 2022 as at 31st of July 2023. So we are required to adjust the earnings per share of the previous year. So we are required to adjust the earnings per share of the previous year. Now, if you check on the earnings per share which are given in that question, in that part, Roman 2, we are told the earnings per share for 2022 was 0.525. But I hope you can see what you have gotten here. I think that question, even the other question, because this was a repetition, that is the same figure. But I think there was a problem with this figure because you can see the earnings per share for this year should be 0.515, not 0.25. So now we are required to restate, to adjust this. The first thing you need to remember is why do we adjust the earnings per share of our previous year? Remember here we have 2 years, 2023, 2022. So we adjust the earnings per share for the previous year in case during the current year, there were some bonus shares. There were some shares which were issued free of charge because you have said such shares are assumed to have been issued at the start of the previous year. And if you check on what you have computed here, you'll be able to see we have some bonus shares. Like number one, we have these 540. So those shares will be assumed to have been issued at the start of 2022. Do we have another bonus element? Yes, we also have this one. So that's why we have to adjust the earnings per share of the previous year. Recall the formula which I've given you for adjusting the earnings per share. I've said we take the PATOS, and I hope you can remember this for the previous year. Or in other terms here, we will take the PATOS now for the previous year, which is 2022. We divide that with the 1/0. Also for 2022. And to this, we add the bonus shares, which were issued during the current year. That is 2023. So if you have that formula, then it becomes very, very simple. It becomes very, very simple. The question becomes very, very simple. So because we have all the figures now, provided you can remember that. So the restated earnings per share, we will take the PATOS for 2022. We have those values here. This is basically the PATOS, the 1/0 for 2022. So the PATOS for 2022 is the 412. The 1/0 for 2022 is 800. So we have that. And then out to this, we need to add the bonus shares, which were issued during the current year. And we have that here. So we have this bonus issue, and also we have this bonus element. Those shares which you have not weighted during the current year, they must be used in terms of restating the EPS of the previous year. So to this, we will add 61, this one, and also this, and also that 540. And basically, we get what? The restated earnings per share for the previous year. So the restated earnings per share for the previous year will be 412. Okay, we have 800 plus 61 plus 540. So we take 412 divided by answer. And basically I'm getting 0.294 shillings per share. So can you confirm whether that is the value you're getting? Is that what you're getting? Is that the value you're getting here? Yes, 0.294. 0.294. Yes, so basically that is it, that what was required there. That is what was required there. I'm trying to check the other question because I've said there was a repetition of another question. This was a repetition of another question which was examined some time back. Okay, can I see the other question? Okay. And what is not clear on the right issue? What is not clear on the right issue? What is not clear on the right issue? November 2018. Yes. So this was a repetition of that question which was examined November 2018. November 2018, question 5. Question 5. Hapo kwa theory. Okay. So let us do another question because you'll also be able to see the other question. Tutatumia approach tofauti. So basically what we do, tunachukua the value of the total. Actually this one we refer to it as market capitalization. Market capitalization ni value ya share zote zimekuwa issued na company. I hope you can see what we have done. Tumechukua zile shares zilikuwa issued before, we have multiplied them with their market price. That is called market capitalization of the share. The market value of the shares issued before, you add the value of the shares issued during the right issue. Basically, that's what you have done. And then you multiply that, you divide that with the total shares which were issued. That should give you the market price of each share after the right issue. But you'll be able to understand better. Once we do another question, you'll be able to see still we will use another approach. But the concept is this. Unachukua zile shares zilikuwa issued before times their market price, and then zile shares zilikuwa issued during the right issue times the issue price. You add that value, and then you divide that with the total shares which will have been issued after the right issue. So the only tricky part ni kama hapa sasa. Ungechukua you 150, it basically means that you are wrong. Lazima we work na zile the actual shares issued before, which will be 800 plus 200 shares. Sasa, yes. But basically, no problem, because I think we will do another question on this. Maybe you'll be able to understand. You'll be able to understand that. Sasa, yes. So I think for today, we are going to stop at that point. There are so many questions on this from those past papers, including our sitting. But if you check on most of the questions, they require the computation of both basic and diluted. So the question, for example, which I've given here is purely on a basic. I don't know whether the other question which Fred is proposing here do have the aspect of diluted. But once we meet now in our next class, what we will do, we will look on what is diluted earnings per share. What is the diluted earnings per share? We look on the steps which are involved in the computation of the same, and then we finalize. We finalize by doing a question having both the basic and also diluted earnings per share. Yes. So I want us to stop at that point. I don't know whether there is any question. I want us to stop at that particular point. Is there any question before we wind up? Any question before we wind up? Any question before we wind up? Awesome. So I think there is none. So let's stop at that point. But equally, you can also check on this question. It's basically similar to this one. Yes. So have a nice evening. We continue from there on Tuesday. or basically the amount of earnings which is attributable to each equity or ordinary share which has been issued by the company. That amount of profit which is attributable to one ordinary share, basically refer to that as what? As EPS. Now, what we said is that all the listed companies, and actually we said listed companies are those companies whose shares are trading in the securities exchange market. They are required by the International Accounting Standard number 33, basically to compute and also disclose two types of earnings per share: the basic earnings per share and the diluted earnings per share. So therefore, these are the two types of earnings per share. These are the two types of earnings per share which the listed companies are required to compute and disclose: basic earnings per share and the diluted earnings per share. And we also talked about the use of this particular earnings per share, or how this earnings per share is used by various users. Number one, we said it can be used in terms of evaluating the profitability of the company. Number two, we said it can be used in terms of comparing the performance of the company in different years. Earnings per share, we said, can also be used to compare performance of different entities within the same industry. And finally, we say that these earnings per share can also be used as a basis of computing something called the price earning ratio. We talked about those particular uses or those importances of these earnings per share. Then from there, we started by looking on how we compute this one. That is the first type of earnings per share, and that is the basic earnings per share. The basic earnings per share. And actually, this one we said is abbreviated as BEPS. BEPS. So BEPS, or the basic earnings per share, we said is an earnings per share which is computed by the listed companies using the profit for the current year, and also using the number of ordinary shares issued and fully paid at the end of the year. So how do we compute this basic earnings per share? Basic earnings per share, we said, is computed by taking the PATOS. We divide that with something called the one-offs. We divide that with something called the one-offs. So basically, we said PATOS. This is a short form for profit, which is also known as earnings, which is basically attributable to the ordinary shareholders. So the profit attributable to ordinary shareholders, and basically we divide that with the one-offs. One-offs is a short form for weighted average number of ordinary shares. Weighted average number of ordinary shares. So basically that's how we compute the basic earnings per share. So in our case, we started by looking on how we compute the first item within our equation here, within our formula, not equation, within our formula. So we started by looking on how we compute the PATOS, which is the profit attributable to ordinary shareholders. And actually, we say this is computed by taking the profit after tax, PAT, or the net income, or the profit for the year. The profit for the year. The examiner, we said, can use any of those words, but basically all these means one and the same thing. So we take that, and basically to this, we said we left two items. We left the preference dividends. The preference dividends for the current year only. For current year only. For current year only. only. And remember, there is something I mentioned in addition to this. We say that you may come across some questions whereby you are told the preference shares issued by the company are basically what? Are redeemable. So we said, in case you come across such a question, you're told the preference shares issued are redeemable. We said we don't list their dividends here, simply because redeemable preference shares, number one, is part of the non-current liabilities. Number two, their dividends are classified as part of the finance cost. Remember, in arriving at this profit, we all expenses, including the finance cost, have already been deducted. So therefore, if the preference shares issued by the company are redeemable, don't list their dividends here, because they have already been deducted in arriving at that profit as part of the finance cost. So to this, we also said that we less the profit attributable to the non-controlling interest. So basically, this is a price whereby we are computing the earnings per share for a group of companies. And then to this, then we said we add any loss from the discontinued operations. Any loss from the discontinued operations. basically should be added there. And whatever you get here, we refer to that as what? We refer to that as PATOS. Remember, that's something we were able to discuss in length in our previous class. We were able to discuss in length in our previous class on how we compute what? How we compute the PATOS. Equally, give more explanation on what we mean by discontinued operations and so on. So in today's session, I want us to look on how we compute this, and then also we do a question from a past paper. So weighted average number of ordinary shares, that is the one-off. So how do we compute this one? How do we compute the weighted average number of ordinary shares? So this one is computed basically by taking the number of ordinary shares which had been issued and free paid at the start of the year. In other terms, we refer to those shares as the ordinary shares which were outstanding at the start. These are shares issued and free paid at the start, and then we add the other shares which were issued by the company during the current year. So this is computed by doing what? By adding. Okay, maybe you can just put it like this: is computed as follows. This is computed as what? As the follows. So here we start with basically balance brought down, and basically balance brought down. We are saying that these are the number of the ordinary shares which were outstanding. The number of ordinary shares which were outstanding. I've said the number of ordinary shares which were outstanding at the start. These are the ordinary shares which were issued and free paid at the start of the year. The number of ordinary shares issued and free paid at the start of what? Of the year. And then to this code we add the shares which were issued in course of the year. The shares which were issued in course of what? The year. The shares issued. The shares issued in course of the year. Now, the shares which are issued by the company during the current financial year, those shares basically can be broadly classified into two main categories. Number one, we have issue at a full market price, and number two, we have the issue at nil consideration. We have the issue at nil what? Consideration. So what do you mean by the issue at full market price? Now, these are those particular shares which were issued by the company during the current year at a price which is equivalent to the market price per share. At a price equivalent to the market price per what? Per share. So these shares were issued during the current year at a price equivalent to the market price. Now, issue at nil consideration, nil we know is zero. So these are those shares which are issued free of charge. And a good example of this is a bonus issue. A bonus what? Issue. A bonus issue, basically, we know that these are those particular shares which are issued free of charge. Free of what? Of charge. Now, is there any difference in terms of how we deal, or we do what? We treat the shares issued at full market price and the shares issued at full market at nil consideration? Is there any difference? Yes. So there is a difference. Maybe I can just put that here as a note. Number one, those particular shares which are issued at nil consideration. Nil consideration, I've said, are shares which are issued free of charge. Free of charge. A good example is a bonus issue. The shares are issued to the existing shareholders of the company free of charge. Now, these particular shares, these shares are not weighted on time basis. Are not weighted on time basis. I'll be able to explain what you mean by that. They are not supposed to be weighted on time basis. I will explain what you mean by that further. But now these shares which are issued at full market price, these one are supposed to be weighted on time basis. Weighted on time what? On time basis. They are weighted on time basis. Let me explain what you mean by weighing the shares on time basis. Let's assume that the financial year of a company runs from 1st January up to 31st of December. That's when the year starts and when it ends. And maybe you're told that on 1st of July here, which is basically 6 months to the end of the year, our company issued like 2 million ordinary shares, and these shares were issued at full market price. Were issued at full market price. We are saying the shares which are issued at full market price, they must be weighted on time basis. So meaning that when talk about the shares being weighted on time basis, it means that these shares should be multiplied with a proportion of time they were held during that year. They were held during that year. For the purpose of computing the one-offs, those shares should be multiplied with the proportion of time they were held during that year. For example, because these shares were issued at full market price, when adding them here, do we add them as 2 million? No. We take 2 million, and then we multiply those shares with the proportion of time they were held. So these shares, we know they were held for 6 months out of 12. So in that case, we have weighted those shares on time basis. We have multiplied those particular shares with the proportion of time they were held during that year. We have done what? We have multiplied those particular shares with the proportion of time they were held during that what? Year. They were held during that year. So all shares which are issued at full market price, that's what you need to know. They are supposed to be multiplied with the proportion of time they were held. But those shares which are issued at nil consideration, they are not supposed to be multiplied with a proportion of time. If, for example, these 2 million shares here were bonus shares, were bonus shares. So when adding them to the shares issued and fully paid at the start, we add them as 2 million. We add them as 2 million. We don't have to multiply them with a proportion of time they were held during that year. They were held during that that year. So that's basically the first thing you need to know as far as the computation of a loss is concerned. And remember here, what you have said is that the shares which are issued by the company during the current year, they are generally classified into 2 categories: issue at full market price, issue at nil consideration. But now I want us to look on how specifically we treat the different types of issues which may be made during the current year. So during the current year, the company can make different types of issues. Number one, we have the issue at full market price. I think I've already experienced that. We also have something called the bonus issue. The bonus issue. Number 3, we have something called a right issue. A right issue. Number 4, we have issue of partially paid shares. Partially paid shares. Partially paid shares. Number 5, we have issue of shares in payment of purchase consideration. In payment of purchase consideration. Purchase consideration. And number 6, we have what? We have something called the share split. The share split. The share split. Number 7, we have shares issued. Shares issued in exercise. In exercise of a stock option. In exercise of the stock option. In exercise of stock option. So I think these are the different types of shares which may be issued by the company during the current year. Now, I think I'll be able to briefly explain some of them which I've not explained here. Like, I think I've already dealt with this one. So basically, we have said that these are the shares which are issued at a price equivalent to their market price. And basically, we have said for the purpose of computing the weighted average number of shares one-offs, these shares are supposed to be they're supposed to be weighted on time on time basis. Anytime you're told the company issued shares at full market price, you just need to do what? To weight them on time basis. They're supposed to be weighted on time basis. In other terms, we have said this means that they should be multiplied with the proportion of time they were held during that year. Multiply them with the proportion of time they were held during that year. During that year. And that will also apply to these shares here. This will also apply to these shares here. And there is something I'm almost forgetting here. we have shares issued in exercise. Okay, that is on conversion of convertible securities. On conversion of convertible what? Securities. So basically, these shares, we have said they should just be weighted on time basis. Then the same case applies to this. That is the issue of shares in payment of purchase consideration. You see, shares basically can be used by the company to make a payment. This is something you know from the topic of group account. What you did in a FAR, financial reporting. So you know that once the parent company has acquired the majority of the shares in the subsidiary, the parent company may pay for the shares acquired in cash, or the parent company can issue its own shares as a form of payment. So shares can be used by the company as a form of payment, can be used by the company as a form of what? As a form of payment. So therefore, once we have shares which have been issued by the company to pay a purchase consideration, how do we treat those particular shares when computing the one-offs? So the shares which are issued by the company to pay a purchase consideration, equally these particular shares are supposed to be weighted on time what? They are weighted on time basis. These ones are also weighted on time what? On time basis. They are also weighted on time basis. Usually the company can issue shares to pay a purchase consideration in a business combination. Business combination is where one company is acquiring another, like the parent company acquiring a subsidiary, or a company can purchase an asset. There is a topic you're going to discuss known as a share-based payment. We can see that, we will be able to see that once a company acquires an asset, the company can pay for that asset by issuing its own shares. So those shares which are issued to pay a purchase consideration, basically those shares are supposed to be weighted on time what? Basis. They are supposed to be weighted on time what? Basis. I'll not be able to discuss that in details. And then we also have here the shares which are issued on conversion of convertible securities. First of all, what are convertible securities? Convertible securities basically are those securities which are issued by the company but which are convertible in nature, which can be converted into ordinary shares. And this is something we came across in the topic of financial instruments. Actually, these convertible securities issued by the company, in the topic of financial instrument, we refer to them as compound financial instrument, convertible debentures, convertible bonds. Now, those are convertible securities. So the reason why we refer to them as convertible securities is because they can be converted into ordinary shares. The holders do have an option to convert them into ordinary shares. So once they have exercised that conversion right, and they have converted them into ordinary shares, those ordinary shares which will be issued to them on conversion, equally those shares are also supposed to be weighted on time what? On time basis. Those shares which will be issued by the company on conversion of convertible securities, they are also supposed to be weighted on time basis. They're also supposed to be weighted on time what? Basis. I think now I can be able to proceed and explain how we treat these other types of issues. These other type of issues. There is something I've explained in relation to the bonus issue, but I need to add something else. Bonus issue, remember you have said, this is the issue of additional shares to the existing shareholders of the company free of charge. So here the company issue additional shares to the existing shareholders free of charge. 2 points to note here. 2 points to note. One, these shares are not weighted on time basis. Are not weighted on time basis in computing the one-offs. So when computing the weighted average number of ordinary shares, those shares are not supposed to be weighted on time basis. So even if they are issued, for example, 2 months, 3 months to the end of the year, never multiply them with the proportion of time. Number two, in case you're given information about the previous financial year, for example, in this case, you are to compute the basic earnings per share for 2024, but also you are given information about 2023, information about what? 2023. So basically in this case, or let me put it like this. Assuming you're told during the current year, the company made a bonus issue. During the current year, that is the year 2024. Now we are saying those shares, we don't weigh them on time basis. So in other terms, what that means is that we assume that those shares were outstanding from the start. The shares were held from the start. That's why we are not multiplying them with the proportion of time. We assume they were outstanding at the start. But anytime you're given two periods, like that case 2024, 2023, we don't assume that they were issued at the start of 2024. We assume they were issued at the start of 2023. Now that assumption has two implications. One, during the current year, don't weigh those shares on time basis. That's the first implication. Number two, because we are assuming they were issued at the start of the current year, it is obvious that when the earnings per share for this year was being computed, were those shares used? Were these bonus shares used? They were not used. And therefore, if the earnings per share for this year has already been computed, we have to adjust it. We have to adjust it simply because we are saying these shares which were issued free of charge, they were issued at the start of 2023. But we are saying when the earnings per share for this year was being computed, those shares were not used. So therefore, number two, we say that use those shares, use them to do what? To restate. To restate is basically to adjust EPS, and that is basic EPS of the previous period, or basically the previous year. How do we compute this restated? It can be known as the restated or adjusted earnings per share, basic earnings per share of this year. So to compute that one, we take the PATOS basically for this year, that is 2023. We can just refer to that as PATOS for P. P to stand for previous year. Are we together? P to stand for previous year. We divide that with the one-nos for previous year. And then out to these PATOS for previous year, we add the bonus shares, which were issued during the current year. Maybe you can just use C. C, the bonus shares for the current year. The bonus shares for the current year. So that is basically how we compute the adjusted earnings per share for the previous year. So we are saying we have to adjust it simply because these shares are assumed to have been issued at the start of 2023. So that is the 2 points you need to know as far as the bonus issue is concerned. Let me first of all skip this one. I'll be able to come back to that. So then let's talk about the shares issued or issue of partly paid shares. Issue of partly paid shares. Issue of partly paid shares. What do you mean by partly paid shares? Partly paid shares, basically, these are the shares which the company will issue during the current year. But when the financial year is coming to an end, those shares are not fully paid. Those shares are not fully paid. For example, our company issued some shares here, maybe 6 months to the end of the year. And the shares which were issued were 2 million. They were issued at a price of maybe 10 shillings. But when the year is coming to an end, we are told maybe the amount which is paid per share is 5 shillings. So it basically means that at the end of the day, the shares are partly paid. So if that is the case, then when computing one-offs, weighted average number of ordinary shares, use the fully paid shares. Use the fully paid what? Shares. Fully paid shares. Use the fully paid shares. We use the fully paid shares. We use those shares which are fully paid. And basically to compute these fully paid shares, compute the amount received. How much amount was received by the company from the shares issued? The amount received. The amount received, for example, in this case here, will be equal to the shares which were issued. This is 2 million times the amount which has been paid per share, which is 5. That will give us the amount received. And then divide that with the issue what? Issue price. You multiply that with the issue price. So that will give us the shares which are fully paid. The issue price is 10 bob. Yes. And then in this case, because these shares were issued at full market price, you have to remember our common rule, our golden rule. Shares which are issued at full market price, always, you must multiply them with the proportion of time they were held, or we weight them. We multiply them with the proportion of time the shares were held. The shares were held. So I think that is basically the other or basically what you need to know as far as these shares are concerned, the partially paid shares. We have already discussed about this one. Then I want us to discuss something to do with the share split. The share split. And share split, I know this is a concept you came across in company law. Is a concept you came across in company law. Share what? The share split. Share split. Now, what do you mean by the share split? Share split basically is whereby the company will subdivide one share into two or more shares. Usually, a share split happens whereby the market price per share or the market price of the company share has significantly increased, maybe due to the good performance of the company and maybe high demand of the company shares. You may see a scenario whereby the company issued shares, maybe at a price of 20 shillings, but after 1 year, the shares are trading at 200,000. I think that happened with Equity Bank some time back. They had to do a share split. So if you issued shares at a price of 20 and maybe the market price significantly increases to something like 200, is always advisable you do a share split. A share split basically means that you may take one share, you split it into 10. So if one share had a market price of 200 and you have splitted that one share into 10 shares, it then means that the price per share will reduce to 20 shillings. We reduce to 20 what? Shillings. We reduce to 20 shillings. So basically what that means is that in case of a share split, if, for example, you held like one share, and basically this one share has been split into 10 shares, automatically that means that you have been issued with 9 additional shares. Have you paid for these 9 additional shares, or will you be required to pay for these 9 additional shares? Automatically no. So therefore, the additional shares which are issued as a result of the share split, they are treated as an equivalent of the bonus issue. They are treated as an equivalent of the bonus issue. The additional shares. The additional shares issued as a result of split, issued as a result of a share split, as a result of a share split, are treated as an equivalent. Are treated as an equivalent of bonus shares. Are treated as an equivalent of bonus shares. Now, in that case, you have to remember what have we said regarding the bonus shares. The bonus shares, number one, we have said we don't weight them on time basis when computing the earnings per share for when computing the one-offs. And number two, we also use the bonus shares to restate. We also use the bonus shares to restate the EPS of the previous year. We also use the bonus shares to restate the EPS of the previous year. Those are basically the 2 points you need to remember as far as the bonus issue, the bonus shares are concerned. I think we are done with that. This one. Yes, let's discuss about that one, and then we finalize with the right issue. So we have the shares which are issued in exercise of stock option. In exercise of stock option. So the first thing we need to ask ourselves here is, what is a stock option? A stock option, basically, this is a privilege which is given to the employees of the company to be able to buy the company shares in future at a price which is below the market price. So an option, a privilege, which is given to the employees of the company to be able to buy the shares of the company in the future at a price below the market price. Or in other terms, the employees will be given a privilege to buy the shares of the company at a price below the market price once the employees have met certain conditions which are set by the company. For example, the criteria set by the company here may be something like the profit reported by the company. For example, if you are in charge of a certain department, you are a manager in charge of a certain, not department, rather branch, you can be told that if the profit of this branch exceeds this amount, the company will give you a privilege to buy its shares at a price significantly below the market price. Alternatively, once you secure a job with a certain company, that company can tell you that if you work with them for the next 3 years, for the next 5 years, you'll be having a right to buy the company shares at a price significantly below the market price. It is a privilege given to you, but you have to meet certain conditions. So once you exercise that stock option, it basically means that as an employee, you have bought the shares at a price below the market price. You'll buy the shares at a price below the market price. And anytime the company issues shares, anytime the company issues shares at a price which is below the market price, then it is assumed that some of the shares here have been issued at full market price, whereas other shares have been issued free of charge. That is the assumption. And therefore, these shares which are issued by the company to the employees who have exercised the stock option, those shares are split into two components. We split them into two components. Number one, shares which are issued at full market price. And number two, we compute something called the bonus element. So the bonus element, basically, these are the shares which are deemed to be issued free of charge. Free of charge. How do we compute these shares which are issued at full market price? So in this case, we first of all determine how much amount was received by the company. When the employees bought the share, how much amount did they pay to the company? And then we divide that with the average market price per share during that year. The average MPS, the average market price per share, average market price per share. And automatically, because these shares are issued at full market price, remember our rule. All those shares which are issued at full market price, we have to rate them on time basis. We have to multiply them with the proportion of time they were held. And then from there, we determine the bonus element. Bonus element are the shares issued for free, which are deemed to be issued free of charge. How do we compute this one? So to compute this, we take the total shares issued, which were issued, how many shares were issued to the employees, and then to this we less the issue at full market price. And basically the issue at full market price, this is basically what you have computed up here using this formula. Using that word, a formula. And then these shares, because they are bonus shares, we then treat them as an equivalent of a bonus issue. What does that mean? It basically means that during the current year in computation of our NOS, those shares should not be weighted on time basis. These ones are not weighted on time basis. They are not weighted on time basis. And equally, we also use them to restate, to adjust the earnings per share of the previous year. Just like what you have said, as far as the bonus issue is concerned. As far as the bonus issue is concerned, that's basically what you need to know as far as the stock option is concerned. The shares, because they are issued at price below the market price, we split them into two components. Issued at full market price, which has to be weighted on time basis, the bonus element, which should not be weighted on time basis. Now, the same concept applies to the right issue. The same concept applies to the right issue. But the first thing we need to ask ourselves here is, what is the right issue? A right issue is a concept you have covered in the other units, including FM, including FR. And basically, right issue, we know that this is the issue of additional shares to the existing shareholders of the company at a discounted price to the market price. In other terms, it is the issue of additional shares to the existing shareholders of the company at a price below the market price. At a price below the market price, just like a stock option. Just like the shares issued in exercise of stock option. So here the share will be issued. Shares are issued at a price below the market price per share. And therefore, the shares which are issued during the right issue, just like what you have said up here, these shares are split into two. One, issue at full market price. And number two, we have the bonus element. Element. So when we talk about the issue at full market price, how do we compute this one? The computation is the same, but with a slight difference. With a very slight difference. So first of all, we compute this one. How much amount was received by the company? And this is basically what you need to remember, the amount which was received by the company. And then do we divide that with the average market price? In case of a right issue, we don't divide that with the average market price. We divide that with something called the theoretical X-rate price. Theoretical X-rate price. This is something I know you came across in FM. Theoretical X-rate price. I'll be able to show you a very simple approach of computing the same, because there was a formula you were using in FM in computation of theoretical X-rate price. What is theoretical X-rate price? Theoretical X-rate price basically is the expected market price per share after the right issue. Once the company make a right issue, the market price per share slightly reduces. So that expected market price per share after right issue is theoretical X-rate price. Theoretical X-rate price. And because these shares are equally issued at full market price, they are supposed to be weighted. They should be weighted on time basis. So what about the bonus element? Bonus element are the shares which are deemed to be issued free of charge. And these ones, the formula for computing this is the same with this one. So we take the total shares which were issued. How many shares were issued to the existing shareholders of the company? Total shares which were issued, and then we less the issue at full market price. We less the issue at full market price. Issue at full market price is basically what we will have computed up there. And basically these ones are not supposed to be weighted on time basis. They are not weighted on time basis. They're not weighted on time basis. I think basically that's what you need to know here. Because once you come across maybe a question, the examiner will usually test, will give you different types of shares which were issued, different types of issues. But the one which is common in all questions for earnings per share, this is something you'll be able to see. All questions for earnings per share, you'll come across the concept of the right issue. You'll come across the concept of the right issue. Simply because two things here. Once you're given the concept of the right issue, you have to compute the theoretical X-rate price. Majority of the students have a problem in terms of computing the theoretical X-rate price. Number two, once you're given a right issue, you have also to split those shares into two components. The shares issued at full market price, and the shares issued at free of charge. The shares issued free of charge, just like what you have said in stock option. Fred, I think you have said there is no much difference. Maybe I don't know what is not clear here in case of a right issue, because you have said just the same with the stock option. The only difference is when computing the issue at full market price. So here you use the average market price per share. Here we use the theoretical X-rate price. Theoretical X-rate price, I've said that price will not be given. You have to compute it. I'll be able to show you a very simple approach of computing the same, because in FM, there was a formula you are using. Do you need to cram that formula here? No. I'll be able to show you a very simple approach of computing the theoretical X-rate price. I hope that Fred is clear. I hope that is clear. Though no need to worry, you'll be able to understand this better as we do an illustration. Now, basically what I want us to do, take a short break, and then once we come back, I want us to do a question on this. We do a question on this, such that what will be remaining will be the concept of diluted earnings per share, which I'll be able to introduce in our next class, and also we do a question. I want us to finish this topic in the next class. Maybe if you're going to do more questions, we will do them during our revision. Remember, we say that this semester is quite short. So there are those topics we will try to rush, especially the topics which were tested last sitting, especially those topics which were examined last sitting. I think we will try to rush, though we may also come back to those topics and we do more revision. So I want us to start with this question here. This question here for August 2023. Let me see. Yes, August of 2023. August 2023. The specific question I want us to do is question 3B. Question 3B. So maybe you can just take a short break of 10 minutes, 10-minute break. Then we come back. Make sure you have that question with you. As we come back after a short break of 10 minutes. Yes. So we take a short break of 10 minutes. We come back at exactly 5:10. Make sure you have that question with you. Yes. So let's continue. I hope you already have that question with you. Yes. So what are we told here? What are we told in that particular question? Question number 3B. So the question is, the following figures appeared in the consolidated profit or loss, another comprehensive income of 𝐻𝐍𝐿 Group for the year which ended 31st of July 2023, together with the comparatives for 2022. So we're given figures for 2023, 2022. What do we have there? We have profit before tax, tax on profit, profit after tax for the period. Then we have other comprehensive incomes, which are revaluation gain. We have the total comprehensive income, and then we have the profit for the year attributable to owners of the parent and also attributable to NCI. We have the total comprehensive income for the period attributable to the owners of the parent and the non-controlling interest. Then we are told in the other paragraph, the following figures were extracted from the 𝐻𝐍𝐿 Group statement of financial position for the year which ended 31st of July 2023 and the comparatives for 2022. So we have the equity share capital. Remember, this is the same with the ordinary share capital for 2023, 2022, 4% preference shares, which we are told are non-redeemable. And then we also have the share premium, the retained earnings, other equity reserve, non-controlling interest, and then the total equity. We have additional information. We are told during the year which ended 31st of July 2023, the following changes took place to the issued share capital of 𝐻𝐍𝐿 Group. Number one, 200 million equity shares were issued in conjunction with the acquisition of another business. These equity shares were issued at full market price, at the date of the issue, which was passed November 2022. Number two, 300 million ordinary shares were issued for cash to existing shareholders on 1st February 2023. The issue price was shillings 1.5 per share, which represented a discount of 25% on the traded price immediately before the issue, which was 2 shillings. 3. On 1st July 2023, a bonus issue of 550 million shares was completed, capitalizing shillings 270 million of the retained earnings. Also on this date, the preference dividend due for the year and equity dividend of the sharing 46 million were paid. So what are we required, or what are we required? We are told applying the requirement of IS 33 earnings per share to the information above, calculate Roman 1, the
sure we are recording. So now we have missed something, but no problem. So we are saying, so maybe just a recap. So we have said time value of money, it is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here, shillings 1 million, and here we have shillings 1 million. So we're saying the value of 1 million shillings today, this, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million, because this, it may be, maybe if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount will be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable, because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value, or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But we want to know what is the worth. What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting its determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number 1. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So, just write concepts of compounding, or compounding techniques, and we start with the first one: future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So, we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal: 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you're paying or receiving 400,000. That is an annuity. Or each year you're paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. you cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah? But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear, a lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus r power n. Principal times 1 plus r power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of a future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future. No. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus r power n. This factor here, this factor 1 plus r power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus r into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. It's important for you to write this formula. Just write this. Just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there?